Chapter 3, Financial Intermediaries. Part 2. Types of non-banking financial institutions. 1. Risk pooling institutions. Insurance companies collect premiums from many people and use that pooled money to pay out claims when someone suffers a loss. Examples are LIC and New India Assurance. 2. Contractual savings institutions, pension funds and mutual funds where individuals invest regularly over time. Pension funds give retirement income while mutual funds give returns through market investments. 3. Market makers, broker-dealer institutions that quote buy and sell prices for financial assets and facilitate transactions. They improve liquidity by always being ready to buy or sell securities. 4. Specialized sectorial financiers. They serve a specific sector only, like real estate financiers who give home loans, leasing companies that fund equipment, or payday lenders for short-term personal needs. 5. Financial service providers, brokers, management consultants, and financial advisors who work on a fee basis, helping investors make informed decisions and facilitating transactions in the market. Merchant bank and merchant banker. A merchant bank is a financial institution that underwrites corporate securities and advises clients on issues like mergers, acquisitions, and capital raising. The word merchant means a trader or business dealer. The word banker means one who manages banking or financial activities. A merchant banker is any person or organization engaged in the business of issue management, helping companies sell, buy, or subscribe to securities and providing corporate advisory services related to such issues. For example, when a company wants to launch an IPO, a merchant banker manages the entire process from drafting the prospectus to getting the shares listed on the stock exchange. Objectives and obligations of merchant bankers. 1. Objective, channel savings to manage and direct the financial surplus of the general public into productive investment avenues that generate returns for investors. 2. Objective, coordinate intermediaries to coordinate the activities of all parties involved in a share issue like registrars, underwriters, brokers, printers, and advertising agencies. 3. Objective, ensure compliance, to ensure that all rules and regulations governing the securities market are strictly followed throughout the issue process. 4. Obligation, code of conduct. Merchant bankers must act with integrity, fairness, and due diligence, never mislead clients, and always disclose conflicts of interest honestly. 5. Obligation, restriction on business. Merchant bankers other than banks and public financial institutions cannot carry on any business outside the securities market. 6. Obligation, maximum lead managers. The number of lead managers is linked to issue size, 2 for issues below 50 crore, going up to 5 or more for issues above 400 crore. Functions of merchant bankers. 1. Management of debt and equity offerings. They help companies raise funds by designing instruments, pricing the issue, registering the offer document, and marketing it to investors. 2. Placement and distribution. They distribute various securities like shares, bonds, mutual funds, and insurance products through their institutional and retail networks across the country. 3. Corporate advisory services. They offer customized solutions to companies on financial problems including restructuring, mergers, acquisitions, and capital structure planning. 4. Financial structuring. They determine the right debt-equity ratio, explore cheaper sources of funds, and design revival packages for sick companies in coordination with banks. 5. Project advisory service. They assist clients in conceptualizing project ideas, conducting feasibility studies, and preparing detailed project reports for funding and implementation. 6. Loan syndication. They arrange loans for clients by analyzing cash flows, preparing loan memorandums, and circulating them to banks and financial institutions for participation. Services offered by merchant bankers. 1. Project counseling. They review project ideas, assess technical and financial feasibility, prepare project reports, and help obtain government approvals and licenses for implementation. 2. Loan syndication. They raise rupee and foreign currency loans from banks and institutions in India and abroad, arrange bridge finance, and manage cost overruns for projects. 3. Management of capital issues. They manage the entire public issue process, from pre-issue planning, drafting prospectus, and getting SEBI approval to post-issue allotment and listing on exchanges. 4. Mutual funds. They help establish and manage mutual funds that pool savings from the public and invest in a mix of corporate and government securities for returns. 5. Portfolio management. They advise or directly manage a client's portfolio of securities, making investment decisions based on the client's financial goals and risk tolerance. Qualities of a good merchant banker. 1. Leadership. They must have strong communication skills and updated knowledge to interact confidently with clients and guide them through complex financial decisions. 2. Aggressive action. They must proactively look for new business opportunities, quickly grasp client problems, and provide the best solution faster than any competitor. 3. Cooperation and friendliness. They must be cooperative, friendly, and persuasive to win the trust of clients, like a doctor or lawyer who builds a long-term relationship. 4. Wide contacts. Their business depends on having good connections with government offices, financial institutions, stock exchanges, brokers, legal advisors, and media. 5. Problem-solving attitude. They must approach difficulties with a positive mindset, communicate effectively, and provide practical solutions to complex financial challenges their clients face. 6. Inquisitiveness for new skills. Merchant bankers survive by staying updated with the latest information and knowledge in their field. They must constantly learn to serve their clients well. Role of merchant banker in primary market. 1. Issuer's advisor. They advise companies on the best way to raise capital, whether through equity, debt, or hybrid instruments, and help decide the structure and size of the issue. 2. Underwriting of securities. They take on the risk of buying any shares that investors do not subscribe to, guaranteeing that the company raises the minimum required capital. 3. Drafting of prospectus. They prepare the offer document, which gives investors all important details about the company's financials, management, risk factors, and the securities being offered. 4. Regulatory compliance. They ensure the company meets all legal requirements set by SEBI and stock exchanges before, during, and after the issue process. 5. Marketing and distribution. They design marketing strategies, organize roadshows and presentations to attract institutional investors and high-net-worth individuals to subscribe to the issue. 6. Post-issue services. After the issue, they ensure shares are listed on exchanges, monitor market performance, and attend to investor grievances related to the public issue. Share brokers, meaning and types. A share broker is a professional or firm that acts as an intermediary between buyers and sellers of securities on stock exchanges, facilitating the buying and selling of shares on behalf of clients. The word broker means a middleman who facilitates a transaction between two parties in return for a commission. Full-service stockbrokers offer a complete range of services, including trading, investment advisory, research, and portfolio management. They have branches all over India but charge higher commissions. Discount stockbrokers primarily operate through online platforms and offer only trading services without advisory facilities. They charge much lower commissions, making them popular with self-directed investors. For example, Zerodha is a discount broker while Kotak Securities is a full-service broker. Both help you buy and sell shares, but offer very different levels of support. Functions of share brokers. 1. Advising clients. Brokers keep themselves updated about market conditions and advise clients on which stocks or securities to buy or sell to maximize their profits. 2. Handle trading platform. They facilitate actual trading on behalf of their clients on the stock exchange and maintain proper records of all transactions and statements. 3. Managing client portfolio. Brokers handle and monitor their clients' investment portfolios, provide regular updates on changes in value, and answer queries about investment decisions. 4. Advise investment strategies. Since markets change frequently, brokers suggest updated investment strategies and new opportunities that can help clients gain better returns in changing conditions. Role of share brokers in stock exchanges. 1. Intermediary between buyers and sellers. Brokers execute buy and sell orders on behalf of clients on the stock exchange, ensuring all transactions happen in a timely and efficient manner. 2. Market access. Individual and institutional investors cannot directly access the stock exchange. Brokers provide the license gateway through which all investors can participate. 3. Execution of orders. Brokers place clients' buy and sell orders on the exchange at the best possible price, acting in the best interests of their clients while following market rules. 4. Research and advisory services. Full-service brokers provide investment research, market analysis, and advice that helps investors decide when to buy, sell, or hold their securities. 5. Record keeping and settlement. Brokers maintain records of all client trades and holdings and manage the settlement process, ensuring securities and funds are exchanged properly between parties. Thank you. For skill development questions, subscribe, share. Refer to Chapter 5 of IFS.